Hey, what's up, y'all? Good morning, good evening. Hope y'all blessed. Today, I'm going to be teaching you how to trade stock options. You want to know what a stock option is? A stock option is you're buying a call or a put. A call means you're betting on the stock going up. A put means you're betting on the stock to go down. Okay? Uh, this is beneficial because you can make way more money trading stock options than just buying and holding the stock. Almost 50, 100% plus, and you spend less money. So this is why doing options is really where it's at. Okay. First and foremost, I want to make a disclaimer. I am not a financial advisor. Uh, Everything I say, take it with a grain of salt. I think you should consult with a financial advisor. Trading has considerable risk. I don't want nobody losing money. I want to just, tell you what I do, and hopefully you can gain some knowledge and expertise from doing it, and because it's been extremely beneficial for me, and I want to teach y'all how to do it. And I'm gonna be showing y'all the step-by-step process on Robinhood, how to trade options to make a bunch of money. I'm telling you, with a little bit of money, you can make a lot of money. Okay, so without further ado, let's get right into it. All right, first things first, you're going to open up your Robinhood account. If you don't have a Robinhood, I'll leave a link in the bio so that you can sign up and get a free stock with this Robinhood account. And you can use Webull too. Okay, so this is my Robinhood account. I trade stocks. I swing stocks on here, but I mostly trade options on here. And so today I had a pretty decent day. I made $1,100 at the top. I started this account with like $10,000, and I've grown it trading options. This buying power is 16,000. This is the amount. So with the stocks, options, and buying power, it equals 41,000. The buying power is the amount of money that I don't have held up in stocks or options right now that I can buy more with. So these are a couple call options that I have. So there's two types of options. There's calls and there's puts. Calls means I'm betting on the stock going up. Puts mean I'm betting on the stock going down. Stocks go up and down every day. It's just a matter of, if you heard somebody had bad news, you might want to do a put on it. Or if you hear Apple was about to split or they have a new iPhone coming out, you want to do a call on it. You're banking on it going up. With Robinhood, right? If you click on the center, this right here, it'll show you some news. It'll show you, okay, some things that's going on. You can scroll this and you can determine like, oh, Lyft and Uber were granted stay. They were about to get banned in California, so people were doing puts on them, banking on them going down because it was bad news. And then they approved them to stay, and so they went up again. So you can look at the news on here. And also, when you first get Robinhood, you have to go to your settings and you have to apply to do options. It's not going to automatically be on there. You have to go to your settings somewhere and apply to do options. It's a very simple process. You just have to make it seem like you know what you're doing. Your experience is going to ask you some questions because they want to make sure people don't lose money. So just answer the questions wisely if you want them to approve you. It's very simple. Okay. So the first thing you want to do, right? Let's type in the name of a company, Apple. Favorite company. I love it. Let's look at the 5-year chart on Apple. It started at the left. It's been going up and up and up for the past 5 years. Phenomenal, right? Great company. I love Apple. It went crazy today. Let's scroll down. It's going to show you all the stats, statistics on it, some news, everything like that. It's going to even have a little analyst rating. Some people recommend buying, holding, and selling. I wouldn't pay too much attention to this. I would say you should buy long term. Apple is it's my number one. I love Apple. Like I would buy Apple long term and never sell it. But I will also do call options. Right under here, it'll show you their earnings reports, how they've been doing, and and stuff like that. And other stuff below. It'll show you who the CEO is and their market cap, things of that nature. All the news on Apple, right? So let's say you thought Apple. First thing you want, like you look at the 5-year chart. This looks like a great chart, right? Amazing chart. It's just going up and up and up every year. Many people wonder, oh, is it going to go down? Stocks go up and down every day, but if you pick the right stock, it's going to go up more than it goes down. Apple will never come back down here again. Okay, it will never. They're doing a stock split, so technically it's going to look like it is, but they'll never drop as low. For every $1, say you bought it at $1, it goes to 10, then it drops down to 5, then it goes to 15, then it drops down to 10, then it goes to 20, then it drops down to 15. It's going to go up significantly higher than down if you have a good company like Apple. Let me just show you a bad example chart. GE. Let's look, this is the day, so it had a choppy day, but let's go to the 5 year. It was here 5 years ago, and it's been going down and down and down, right? I wouldn't invest in this company long term because it's just been going down and down for 5 years. You don't want to invest in that, and I don't think it has much potential. Let's look at another bad company, Macy's. This was the day, but all you have to do is click on the 5 year. It's on this, like right here, 5 year. This is the past 5 years. It's been going down and down and down for the past 5 years. I would not put my money in this. Not long term, So you would know. Look at that 5 year chart, so you can know you're doing a call on a good company. Okay. So Apple. First thing I want to do, you pull up the stock, you look at the 5 year chart. It's been going crazy. I think Apple is going to go up. Eventually hit $500 in no time, right? I want to see the 52-week high, 473. Okay, so after hours it went up some, so that's going to adjust tomorrow, probably when the market opens. So I would do a call option banking on this going up, right? Also, before you buy an option, right, make sure you wait for a red day. Even though the stock is super high right now, it's going to come down. They don't just keep going up. It's going to drop a little bit. Even if it goes up $50, it's going to eventually drop down a little bit, and that's when you should buy. You should buy it on a red day. This is a green day because it's green today. If it was red today, let's see, Baba have a red day. This is red, right? So it had a red day. And you can kind of see from this right here. If they're red, they had a red day, which was, kind of a bad day, but it's more so like a sale day. You bought it, you can buy it on sale. Green means it's already high, so I wouldn't buy it when it's green. Just wait till it goes on sale. Wait for it to come down a little bit. And when you see it have a red day, then that's when you can buy it. Okay, so Apple, I think Apple is going to go up, right? I'm going to look at the 52-week high. It just passed that. I think it's going to get hit 500. So you go to trade options. This is going to pop up, right? I wouldn't really worry about this first page. It's just like kind of informational. There's many different ways to do options. You can do straddles. You can do covered call, covered put, meaning you're buying a straddle would be like you're buying a call and a put at the same time so that you can kind of hedge it. So if it goes in one direction, you can sell it, and then it reverses and go in the other direction, you can sell that one. But I would say the simplest thing for you to do is just to buy one at a time, a naked call, okay? So you're going to go over to the dates. It's going to show you a series of dates. The further away you get, the more expensive it's going to be because it's more guaranteed that the stock is going to go up by that date. We all know it's going to reach a certain, it's going to go up in price by January. It's not just going to stay the same price, right? So I would recommend, first things first, looking at the date up here, I would get at least 3 to 4 weeks out, right? Just so you give yourself enough time, right? Maybe 2 weeks, even 2 weeks. But don't do weeklies, right? Do at minimum 3 to 4 plus weeks out, right? Do these out here because it gives yourself enough time for the stock to go in your direction if you're doing a call, which means you're banking on it going up. So the share price is going to have this. Let's look at this as a middle, the share price, right? It's 476.69. Everything under this share price is in the money, meaning it's every dollar it goes up under here, it's going to be $100. So every dollar Apple goes up, it's going to be $100, okay? And you can make that money up until your contract expires, but I would not hold a contract until its expiration date. If it's September 4th, I would probably sell it a couple days before it. So if you have a contract for 2 weeks, you should sell it within a week. If you have a contract for a month, you should sell it by the 15th day. Just think of half the time, right? Because it's time decay on some of these ones, but that's if you're in the profit. If you're not in the profit, maybe wait for you to get some profit and then sell it. Okay, so these are in the money, right? And these above this, everything above this share price is out of the money. So these are cheaper, and it means you'll start making money. You start making money, but less than $100. You start making a little less because these are cheaper and they're out of the money. Okay, you can try to stay in the money if you have the money. So let's say you want a 475 call, right? This 475 call right here says it's $12.48. What you're going to do is move that decimal point over 2 to the right. You don't even have to do that, nothing, but that's just for you to know. This is actually $1,248 or $1,250, but that is basically, when you see these 1483, it's really just like 1,483. Just move the decimal 2 to the right. I don't know why it's there, but that's what it is. So let's say you wanted to do a 475 call, right? You see the break even. once it breaks past that even point, then you'll be able to own the shares. And if you wanted to hold it, if you held it until past September, if you held it until September 4th and it reached that break even amount, and you wanted to buy the shares for 100 shares for 475, because when you buy in a contract, you're buying you're renting. It's basically like you're renting 100 shares of somebody's stock at this at a call option price of 1,248. You're just renting it to make a profit, and then after you make your profit, you're selling it back to them because you don't want it. So all you have to do is make sure, and the stock doesn't never even have to hit that break even. It just has to go in the direction. So if this goes to 477, 478, 479, you'll make $300. You're making money, and you can sell it at any point. You can sell it the same day. You can be like, oh, I made 300, I'm leaving. Or you have until September 4th, so you can say, hey, I want to keep I want to see if it goes higher and keep making money, and you can just let it keep running. I would say, try to aim for at least like 30%, 30% or more. But sometimes if you have a further away contract, you can honestly make like 100%. Like, I do it every day. It's crazy. So let's say you want to do a 475 call. The break even price, I would just worry about it going in that direction. So look at the break even. This is a 475 call, right? So it says 1248. That's 1,248. You will buy one contract. One contract is you're basically renting 100 shares of the company. This is why this is beneficial. So to rent 100 shares of Apple is $1,250. Let's just go back to Apple's chart. If you wanted to buy 100 shares of Apple, it would be $47,000. That's why it's more beneficial to do options, because you're just renting it and you don't have to pay that hefty cost, and you'll still make the profit with less money. Okay? So let's say you just wanted to buy one contract. It's going to have a limit price. The bid is the price that people are bidding on it, and the ask is the price that the owner wants. Robinhood automatically puts it in the middle. So you don't even have to adjust it. It's automatically going to adjust to make it fair for both parties, right? So you're just going to click on that limit price. It'll have a tab, right? This is three key factors you want to look at when you're doing an options contract. Look at the bid and the ask. You want this to be at least idealistically, really tight, like a tight gap. This is it looks like a 70 cent. No, 50, 70. Okay, like a 50. You want it to idealistically be within 50 cents to no more than $1, but idealistically like 50 cents, right? A very tight, area, because it's easier to sell. If it's too much space, it's going to be harder to sell. Let's go to an example of one that has, let's just say, a $700 card. It's unrealistic, right? So when you click on this, right, this one is only $10, right? $10. Oh, this isn't bad, actually. $10. This is a good one. This is a good one. Sorry. Damn. See, so you can buy an option as cheap as $10, right? And if you look up that option right there, that's up 11% today. You can buy options super cheap. So you're not going to make $100 every time it goes up because you bought a cheaper option, but you'll still make money if you bought a bunch of those. I'm trying to show you an example of a bad spread. Apple's just a good stock, so they're all pretty tight. Anyway, so let's just go back here. So limit price, right? You're going to look at the bid and the ask. Make sure the bid and the ask is between 50 cents. If it's more than that, less than $1, okay? So this is a very tight knit one, right? Great. So click on that because that's important, right? It has a lot of volume, right? So a lot of people are, trying to have these call options and they're interested in it. This is a good one, right? The second thing you're going to look at, all you need to look at is the bid and the ask. Make sure that is within 50 cents of each other, and look at the Greeks. Now these Greeks represent a bunch of things: the price, amount of money you make when it goes up, the time decay, a lot of other stuff. The only thing you need to know: the delta and the theta. The delta is the amount of money you will make when it goes up. The theta is the amount of money you'll lose when it goes down, and the time decay. You want the delta to be higher than the theta. So with this delta, remember what I said about that decimal. Move that decimal point over 2 to the right. This is $49 every time it goes like in your direction. The theta is $44. You can lose that every time it goes down. Okay, and stocks go up and down. You can find a contract with a better theta and delta. Let's go to this $500 one. This is a 510 contract. The limit price is good bid and ask because it's less than 50 cents. Let's click on it. But you see that delta down there is higher than that theta. So that means, you risking making less money and you would lose more money. I wouldn't get that one. I would find one that's a little more, tight. Okay? So look at that delta and that theta. Make sure that delta is higher than that theta. You can find way better ones if you just search a lot. You can probably find one that was like $49 and the theta would probably be like 20 something, like $20, Like you can find ones that have those. Those are the ideal ones. This one is kind of 50-50 almost, but it's still, it's still more upside than downside. So when you're getting this, all you need to look at is limit price within 50 cents. That's good. So I can sell this easily. The delta is higher than the theta. That's good. So that's $49 for going up, $44 if it goes down. You'll lose that. And I'm paying $1,250. So all I'm going to do is hit review and swipe up, okay? That's it. Hit review and swipe up. Now, once you have that, the market is closed right now. It'll be right here in your options tab on your page, right? So I have right now, I have a car for ARKK, right? It'll show me, I just bought this today. It'll show me, it'll show you the amount, like I have until March 21st, and it'll show you what I paid, $174, which is $174. That's the average cost, and then they'll show the current price, $185, right? So far I'm up, 6%, $11, and I only put up the equity. I only put up $174. I already have $11 on it, so total $185 in equity. And I have enough time on this. This is for March 2021. I guarantee this is probably going to be, at least 100%. That's what I'm aiming for. So you can find ones that's really far away for really cheap. All it has to do is go in the direction. So this breaks even at 121. It's only $89, but I'm making money because it's going up. As long as it goes in your direction. If I wanted to, I can be like, I got $11. I'm going to sell this, and all you have to do is sell it. You don't have to change the limit price. Just leave it like that and just hit sell. If it doesn't sell automatically, you might have to adjust the limit price and make it cheaper so people can buy it. So you might want to put it like a 184 or 180, but that's only if it doesn't sell automatically. But yeah, so it's going to be here. You can sell it at any time. Whenever you're comfortable with profit, I recommend taking at least 30% profit, but don't get greedy. Trust me, in this market with Corona, don't get greedy. If it has a good day, let it run and you make a couple $100, sell it. Cause it can keep running, but it also can go down. So that's why it has risk. So again, let's review. September 4th, I want to buy a call. I'm betting on it going down. Down here is in the money, more expensive, but every dollar it goes up, I'll start making about $100. Up here is out of the money, cheaper, less money you're spending, but less money you're making, but also very good. You can buy a bunch of contracts if they're cheaper. It's $269. You might want to buy 2 of these, maybe 3 of these, because you got more money. 4 of these, and you can sell them. You can sell 2 if it makes some money and let the other 2 run if you wanted to. So that's how you do a call option. You can sell it at any time you make money. Click on here. Make sure the bid and the limit price, the bid and the ask is between 50 cents. Make sure the delta is higher than the theta. That's $49 to $44 loss. Like if it goes down, $49 you can make every time it goes up. $44 you can lose every time it goes down. And these will fluctuate every day. Stocks will go up and down. Do not panic. If you have time and you buy it on a red day when it dropped down and it's on sale, you have time, okay? Don't buy when it's high. Buy when it's low. Apple is high right now. I wouldn't buy this right now if I'm not already in it, because you might be chasing FOMO and people sell up here. You want to buy when this is red. This will go red and green on a weekly basis. When this is red for the day, buy it. When it's green, let it run because you might have already missed that train. Now that's how you do a call. Now, how you do a put. You click on put. So this call and this is put. Call and this is put. You do a put like that. So it's going to be opposite for what puts. You see this right here, the share price 476. Everything above this is in the money. Everything below this is out of the money. So when you did a call, everything below this is in the money. Everything above this is out of the money. When you do a put, everything above this share price is in the money. Everything above below this is out of the money. So in the money means you'll start making more. These are more expensive. You'll start making larger amounts of money and quicker. Out of the money, these are cheaper. You'll make a little less money, but they're more affordable probably. So let's say 476. You can just honestly just pick the one that's right above in the money. So for calls, you can pick the one that's right here. That's right here in the money. But if you don't have that much money, maybe you choose one that's like up here a little bit that's more affordable for you. And all the stock has to do is move in your direction. This is a 490 call. If Apple goes to 478 or 480, you will make money because it's going in your direction. It doesn't have to reach 490. Okay, so let's go to puts. Let's say I think Apple is going to go down. Maybe their iPhones blow up and I see it on the news and I think this stock is going to go down for the day. So I'll get a 480 put. This says it's 1735. That means it's 1,735, probably 1,737. Okay. Or sorry, 1,735. Yeah, I'm tripping. All right. So you're buying one contract, right? That's 100 shares. You're renting this, banking on it going down. Let's look at that spread. That's $17 to $7.70. Ooh, that's a big gap. That's more than 50 cents. It's gonna be hard to sell that. You know, Robinhood automatically puts it in between. But let's see if we can find a better one. You know, let's see if we can find a better one. That's a little better. This one right here, 1410, 1465. 70 cents not terrible. But I like it to be a little, closer. But let's just use this for example. So it's less than $1, but ideally you want it to within 50 cents. So let's look at the bid and the ask. We looked at that. Let's look at the Greeks. The delta is higher than the theta. That's great. I'll make more money when this goes down. So you're making money as this goes down. For every dollar that Apple goes down because it has bad news, or you think it's people are going to sell it eventually, you're banking on you'll make money going down. A lot of people don't know you can make money in the stock market if it goes up or down. It does not matter. This is doing a put. I think Apple's going to go high. It's too high. It's going to eventually come down. Some people are going to sell it. And so you'll do this. The Greeks are great. The delta is higher than the theta, $56 every time it goes down, $44 every time it reverses and goes up because you're betting against it. The volume is okay. You have people interested in they have volume and this has volume, and you have people interested in it going down. And okay, so you would just hit review, hit continue, because it'll automatically adjust the price in between what people are bidding and what the owner wants to rent it at, and you swipe up. At any point in time, just go to this main page. Your call options will be here, and you just hit sell if you don't want to. When should you sell? You should sell if you have, a little profit. Like with puts, stocks more so go up than they go down. So I wouldn't stay in a put for a very long time. I was staying there for maybe a couple dollars, It's a lot of technicals with it, I would recommend doing calls. It may be simpler for people, but pick one, try to master them, do as much research as you can on them before you just jump into a put. But right now I did a call. I'm down $52 on this one right here, but I just got it today. I'm looking at the 5-year chart. Great company. It's progressively going up. Looking at the 52-week high, $4.99. So it's a red day today. That means it's on sale to me. And so I just, and it's been higher than this. So I think it's going to go up. I'm banking on this going up. I have a 9/18 call, September 18th. So I have a couple weeks. And I have a 550 call. I think it doesn't have to hit 550 because the stock right now is 487. It just has to go in the direction of 550. So I have a call right now in play, banking that is going to go up. Okay. So I'm banking that this goes up in price, and when it goes up, I'll make money. If it goes down, so when should you cut your losses? Every option is not a winner. Sometimes they're losers. When should you cut your losses? I would say, if you lose more than I honestly, idealistically, maybe like starting out, because you might. I would say maybe cut your losses. If I didn't believe in it and I just YOLO'd it, I think this is going to go up, but I wouldn't recommend like over 30% loss. Idealistically 20%, no more than 20%. You can probably sell after that, so you don't lose it all. But if you're down a lot, don't trip, don't panic. Like, I'm down $52 on this. I'm not tripping, I'm not panicking. I bought this today, and I have until September 18th for this to go up. So I'm just letting it sit. You don't really have to cut losses, but if you don't want to lose and you don't feel like the company will recover the next day, then maybe cut your losses at 20% and then try to buy it again when it gets lower, if you think it's going to get lower. But the easiest thing to do is let it sit. You have enough time to do your, you have enough I have enough time. That's why I didn't pick 1 week. It's only like, August 24th or something like that. I have weeks for this to go up in the direction of 550, and I think that it will go up there. And so I'm just holding it until I make profit, and then I'll sell it. And you can sell for whatever. You can sell for a couple $100. Like I said, aim for 30% minimum. But if it's running it, you can make 50, 100% in no time. Like, I literally do it every day. And yeah, so that's how you do a call, and that's how you do a put. Yeah, so stay up to date with the news. Uber had bad news today, so they were dropping, and people were shorting it, and then they reversed and said, no, Uber can stay in California. So people start buying it again. So some people did calls, and then it started going up again. So you can look at the news for that. And yeah, if you have any, that's how you do a call, and that's how you do a put. You can make, the percentage is crazy. Like, you can make, I know savings accounts, they may give you 5% in a year. You can make 5% in a day. You can make 50% in a day. Okay, is like, options are the money, and you're selling it right back. You're just in and out of these. Okay, buy low, sell high. Buy red, sell green. Okay, it's red is on sale. Green, don't touch it. Wait till it goes on sale. I'm telling you, you can turn something as little as a couple $100s into thousands. I do it all the time. I did an Apple contract for January, and before they announced their stock split, and I banked on it going up, and I only paid $300 for it, and then within like a week it was up like over 400%, and I sold it for like $2,200, and I didn't put up no money. I just bought a further away one. So yeah, that's the options game. If you guys have any questions, feel free to let me know.